Hey, what's up, everyone? Welcome back to my world of stocks. Welcome back, my beautiful, amazing subscribers. And I want to say welcome back to my 3 stocks on sale series for the month of, what are we in now? August 2025. Time flies. But this is one of my favorite series. Of course, in each episode, I give you 3 new stocks that I think look very attractive at today's prices for the long term. And to make it a little more fun and interesting here, I specifically choose one lower risk, one medium risk, and one higher risk option for some added variety. As always, though, just please do your own research, make your own decisions, guys. But starting with what I consider to be the lowest risk option of the bunch first, I'm going to go with what is probably, I would say, my overall favorite dividend REIT in the entire market right now. And that is Vici Properties, ticker symbol VICI. Now, granted, the other 2 stocks on this list are going to be down much more from their highs in terms of the stock price. But considering how incredibly strong Vici's business is, I still think that the stock is actually being heavily suppressed right now, and it deserves to trade much higher from here. Part of the reason for that suppression, though, is really because the entire real estate sector has just been, I would say, held back by pandemic era trends and high interest rates. Things like remote work and the rise of e-commerce have really hurt offices and shopping malls, while rising interest rates have created some major headwinds for REITs too, like making debt more expensive, which REITs rely on heavily for buying and managing properties, while also raising the yield for low-risk bonds, making REIT dividends less competitive by comparison, and in some cases, they've even hurt their property values too. So why then, though, am I so bullish on Vici stock long term? Well, first of all, interest rates came as a result of inflation, right? Well, guess what? Many of Vici's contracts are actually linked directly to CPI, the Consumer Price Index, which they've actively been trying to grow up to 90% of them by 2035, meaning that, guys, as inflation rises, so too will their rents, because they'll be directly linked. And because most of their properties are actually in America, they not only have almost complete immunity, I would say, to tariffs, but they actually benefit from them in a way if it weakens competition and causes even more inflation. Regardless, though, interest rates themselves will eventually come down too. And once that happens, it'll likely turn into an actual tailwind from all the benefits that REITs typically experience once that happens. So buying into the weakness now, in my opinion, actually makes perfect sense for what is, again, in my opinion, one of the absolute best REITs in the market that is highly insulated from many of the other pressures that I mentioned earlier too. In fact, Vici's portfolio mostly consists of giant cash-generating machines like huge casinos, resorts, and entertainment venues like Caesar's Palace, MGM Grand, Venetian, Mandalay Bay, and more, as well as golf courses and even bowling centers, which, unlike offices and retail stores, these have almost zero exposure to those remote work and online shopping concerns. In fact, during the 2020 pandemic, during one of the absolute worst economic, time periods of our lifetime, Vici was still able to collect 100% of its rent, thanks to those strong properties under long-term triple net leases, where the tenants are actually the ones that are responsible for handling most of the operating expenses. And that kind of resilience in a REIT is just incredibly rare and valuable to me to really have in my portfolio. And yet, despite all that, this is a stock that has been so heavily suppressed, I feel, that it's gotten to the point where their valuation by adjusted funds from operations, a key metric for value in REITs, it's actually cheaper than the sector median. And I love to buy stocks that are cheaper than the sector median, as you guys are well aware from all my videos. While the dividend, though, has also climbed well above 5% too, which is a very attractive level, I would say, considering that it's been grown every year since going public too. And I'm sorry, but there's just no reason why Vici should be trading this low when they're actually, I would say, a market leader. If anything, they should be trading at a much higher premium. In fact, I'd even go as far as to say that what Vici is to like REITs is kind of similar to what something like Microsoft or Amazon is to big tech. Those companies always trade for a premium because of how strong and resilient their business is, right? Well, Vici, I feel, is no different, deserves a premium valuation too, yet it trades for a discount regardless. And personally, I think anytime the dividend rises above that 5% level, it's going to be an automatic buy for me. There's no way that it should be trading at those levels, so it's one that I really like here. For stock number 2, though, our medium risk option. This month, I can't help but notice, guys, what looks like an amazing opportunity for an AI chip leader in ASML Holding, ticker symbol ASML, who is coming off a large dip this week after reporting earnings that sent the stock falling by over 12%, leaving it also down over a third of its value from the top. But here's the thing, guys, I actually thought that those earnings were pretty good. Now, before I give you my opinion on that, just a quick recap here on, let's say, who this company is. If you're not aware of them, their business is absolutely critical for the future of really, I would say, technology in general, but especially in the world of artificial intelligence and advanced chip design. In fact, they're the biggest in the entire world at manufacturing photolithography systems, which are the super complex machines that etch out all the tiny circuit patterns on silicon wafers to create the actual semiconductors. And more importantly, they're the only company, at least the only public one that I'm aware of myself, that actually makes extreme ultraviolet lithography machines too. EUVs is what they are, which are heavily used for producing the most advanced chips in smartphones, computers, and even AI supercomputers. Hence why their sales and profits typically soar by double digits in most years, while continuing to break new record highs on the increased demand from AI. So why then did the stock actually fall again this past week here after reporting earnings? Well, it mostly had to do with weaker guidance than analysts wanted to see, where the company noted that they cannot confirm that they will actually see any revenue growth next year because of tariffs and geopolitical issues. See, ASML is one of the most critical pieces to the global semiconductor supply chain, and so if America is throwing around tariffs everywhere, it ultimately clouds up the whole industry and makes it difficult to predict what kind of impact it's all going to have. In fact, a report from Reuters showed that the price for ASML's machines could rise by tens of millions of euros because of tariffs, which is causing chip makers to postpone factory investments and may lead to delayed orders if tariff concerns persist. So orders, of course, for ASML machines. However, I personally think that it's an overreaction here by the market, and here's why I feel this way. First of all, like I said, tariffs will eventually go away. But you know what's here to stay? The trillions of dollars that you're about to see in AI spending over the coming years, to which ASML will play a very important role. And we're already seeing that. In fact, for as worried as investors were about those Q2 earnings in that report, it still showed sales rising by a whopping 24% year over year, with net income soaring by even more at a 44% rise too, both of which beat analyst estimates, with order bookings also coming in 25% above forecasts. And even with all the concerns, ASML is still expecting 15% revenue growth this year too. Literally the only thing kind of holding them back right now is that they simply don't know what to expect the year after in 2026. But in my opinion, the CEO's comments weren't even as alarming as I would say as much as they were just kind of logical, where he simply stated, this is quoting him here, looking at 2026, we see that our AI customers' fundamentals remain strong, but at the same time, we continue to see increasing uncertainty driven by macroeconomic and geopolitical developments. Therefore, while we still prepare for growth in 2026, we cannot confirm it at this stage. So to me, that doesn't scream that this is a company that is about to get destroyed. It's just the reality of the situation where it's hard to predict how these headwinds will, exactly affect them here in the short term. But even by next year, I have to imagine that most trade deals are going to get signed and the environment will slowly improve, with even America itself wanting to build more chips here at home, and they're going to need obviously ASML's machines in order to do that. But meanwhile, the stock is dirt cheap, with a forward P and PEG ratios that are around 19% cheaper than the sector and a whopping 35% cheaper than their own 5-year averages too. And while this is not typically thought of as a great dividend paying stock, the yield has at least risen above 1% now because of the stock dip, while carrying some excellent growth metrics to go along with it. Honestly, the only reason why I haven't gone ham on this stock myself is because I just already own so many chip stocks as it is, which I have huge exposure to. But if I was just kind of starting out to build, I would say like a portion of my portfolio for specifically some AI and chip stock exposure, ASML would be right near the top of the list at these prices. And even now, with all the chip stocks I already have, I'm actually considering still picking this one up too. It's looking very attractive. But anyway, that was stock number 2, guys. Let me know what you think about it. But moving on to stock number 3, we'll finish up here now with the final stock, what I consider to be the highest risk of the bunch. Sorry, one second. And for this one, I'm going to go with another stock here that actually just reported earnings recently in the telecom giant Verizon, ticker symbol VZ, who, in contrast to ASML, the market actually liked their second quarter results, where they beat analysts' expectations on both the top and bottom line, while also raising their full year guidance because of strong demand for their premium plans, as well as, get this, guys, new tax laws from the new Trump administration that are set to boost them by so much. In fact, Verizon's CFO now expects the company to generate an additional $2 billion of free cash flow this year, which in my opinion is by far their most important metric. And I'll show you why that is in just a second. Keep that in mind though. Free cash flow is very important for a company like this. But as Wells Fargo analysts pointed out, Verizon typically pays the highest taxes among US telecom companies. So these new tax incentives, not getting political here, just like, obviously some people don't agree with them, but some people do, regardless of what any personal opinions are on politics and all that kind of stuff. The point is that it's obviously going to help a big corporation like this, like Verizon, big company. And it's going to, according to Wells Fargo analysts, it's said to provide a significant financial boost to the entire industry. And as such, Wall Street sent the stock climbing by around 5% on the positive news. If, however, you're wondering though, dang, the stock is climbing now, did I miss the opportunity on this stock? The answer is no. You absolutely did not miss anything, because this is a stock that is still negative here over the past decade. In 10 years, guys, the stock is still down. It's still negative. And from the top, it's also lost more than a third of its entire value too, causing the dividend yield to also rise to more than 6%. I mean, it's a huge dividend. And remember how I told you guys that Vici I consider to be a strong buy above 5%? I think the same thing can really be said about Verizon above 6% too. It looks very attractive at those levels. In fact, I think the only other time that it even broke north of that level was during the Great Recession. So that should tell you just how, rare it is to be able to get it at these levels. And so because Verizon's dividend is yielding such a high amount, I just don't think that Wall Street is going to be able to let the stock keep trading at these prices. I feel that they're going to start to buy the stock more. That's going to raise the price, and it's going to lower the dividend yield because of it, especially when you consider that the valuation is also trading at about a 50% discount to the rest of the sector, which doesn't make any sense for what is actually the market leader, the most market share, and easily carries the highest quality of service among all their peers too. And by the way, you remember how I mentioned earlier that free cash flow is actually their most important metric to watch? Well, the reason why I say that is because Verizon carries gigantic levels of debt, north of $100 billion. This is where all the high risk comes from. This is why I categorize them as the highest risk. It's nothing to look past. It's a giant issue for sure. And of course, also being a telecom company like this, they typically experience low growth. So high levels of debt, low growth, not a good combination. But I would say that as long as they can maintain their high free cash flow, which comes after all the capital expenditures, that's why it's an important metric in my opinion, then that should allow them to afford their dividend while still paying down their debt. And that's exactly what I think the case is here for Verizon, who generated close to $9 billion in free cash flow through the first half of the year, which easily covers the less than $6 billion in dividends and still leaves a few billion left over to pay down debt too. Case in point, their unsecured debt fell by about $6 billion in the period, while their cash actually increased by $1 billion too. So now you're adding an additional couple $1 billion from tax incentives. That's going to really help secure that dividend, which is usually the biggest concern that investors have about Verizon, because they have so much debt. Well, they need to cut that dividend in order to pay down debt. If you're generating an extra couple $1 billion seemingly out of nowhere, in my opinion, I think that dividend is going to hold there. I don't see why they would cut it. Of course, we never know what management is going to do. So at any moment, they could shock us and actually decide to cut that dividend, which could happen. Obviously, it happened with like AT&T. It's happened with many other companies. But for now, I've been a buyer, and I've actually had this stock for a little while now, and I've been collecting some really nice dividends on it. So already it's paying off for me, and I've enjoyed holding it. But hey, that's going to do it for this month's episode, guys. Let me know what you think down below. Do you like any of these stocks, and what stocks are you buying? Let me know that as well, so I can make videos about those stocks too, in case you want those. But thanks again for all of your support, my friends. I really appreciate that. I hope you're all doing well, and I will catch you in the next one. Take care, everybody. Bye-bye.